So I'm going to give you, like I try to do every week, which is both the positive view of the economy and the stock market. I try to focus it a little more on the stock market, the positive view and the negative view. Those who think it's going down a lot and those who think that have more of an optimistic view. So today I'm going to cover Mike Wilson, Chief Investment Officer at Morgan Stanley, David Hunter, economist, author, and Ed Dowd, economist. And you'll see different views, and I hope that's helpful to you. My name is Ben Reppond. Welcome to my YouTube broadcast. Today is Tuesday, May 27th, 2025. I'm going to begin with Mike Wilson. Played him many times before, and he's being interviewed by Dan Nathan. Dan Nathan does a podcast, but he's also on Fast Money and CNBC, but he does a good job interviewing Mike Wilson. He, all of these, I think, try to stay out of the political realm. If they get very political, I won't play them regardless of which side they're on. He has a discussion on Trump's strategy and its impact on the stock and bond markets. But I think you will hear this from the view of being presenting it in an impartial way. He takes an optimistic view. The fact that during the first, I'm going to say 9 months of this year, it's not precise, but somewhere in there, we are getting tariffs and other deals that Trump is coming up with, and they are a bitter pill because they have so far been moving the market mostly down. Then the goal is, he discusses the strategy. He thinks that Trump's strategy is that then he will come in with, and here's the payoff, and that it will push the market higher later this year and next year. So the timing of all that, to say that's going to happen in this quarter or that quarter, can be imprecise. But anyway, he discusses that, and when you look at it, the way I was looking at it was through Trump's eyes and saying, from a strategist, how do I want to do this? If I'm Trump, how do I want to do this so that I eventually get to the point, by the time we get to the midterm elections, that things are positive? And, and Mike Wilson kind of supposes that and says, this is the way I would probably play it, which is the way Trump is playing it. Will it work? We don't know that. But that's, it's an interesting view, political view, without, I think it's pretty apolitical. He presents it in a more objective way, not a very much for Trump or very much against Trump. It's just more like, this is just from a strategy standpoint, this is what's going on. So take a listen to Mike Wilson.
The last month was certainly something that very few people expected. You came into the year very constructive on the back half of the year, but you thought there was going to be a lot of volatility in the first half of the year. How do you know that, Mike?
Well, I mean, it really came down to kind of the difference between Trump 1 versus Trump 2. The person's the same, okay? The agenda is generally the same. They ran on the same platform, but the cycle was very different, okay? So in 2016, as you may recall, we were just coming off a global manufacturing recession. We were fighting secular stagnation. Inflation wasn't even in the cards. And so when Trump came in, it was like kind of the perfect guy to reflate, right? Basically borrow, spend, and get the thing going. So when he came in 17, we were very bullish on his first term because he said this is the perfect person to reflate the economy. It's very good for stocks, and it was. And this time around it was different, right? Because we had no slack in the economy. We had inflation right under the surface. We had basically no output gap. And so I think the administration understood this, at least several members of their cabinet. And so they had to do the growth negative stuff first, which is immigration enforcement. You do the DOGE or fiscal constraint, and then of course tariffs. And we also had something you're well aware of. We had AI sort of peaking. And we talked about that, I think, in January, that there was going to be a deceleration in CapEx, not negative growth, but that those stocks had to kind of reset. So the combination of all that we thought was going to weigh on the market in the first half of the year. And then ultimately we thought they would get to the pro-growth stuff in the second half. And then it became more obvious as they told us that, right? As you got through the first quarter, I think most people thought Trump would never let the market go down. I kept hearing that. I'm like, that's kind of crazy to say that.
Well,
but,
he only let it go down for a few weeks,
right.
by the way. So so you
Yes.
and I will disagree on that.
Well, no, what I'm saying is I think people were just focused on the wrong thing, which is, and then of course Besson really laid it out. So Scott Besson, smart guy, obviously former Wall Street guy, investor. He understands that sequencing dynamic, and so he basically told us, like, we're not worried about the stock market, we're worried about the bond market, which, by the way, is the right narrative. And we're not going to own this economy for the first 9 months. So he set it up in a way that I would do it if I was a new CEO coming in and I want to kitchen sink the first half, blame it on the last administration or the last CEO, and then do the growth positive stuff. So I think that all played out. Where we got tripped up a little bit on that narrative is just how dramatic the Liberation Day announcement was. And then we basically crashed. So it just happened so quickly. And then, of course, Trump did pivot to caring about the markets, bond and stock markets, and we're back off to the races. So I think our original narrative coming in was right. It just played out much faster and more dramatically than we would have expected. So I'm not surprised that we've rallied back. I am surprised we rallied back this fast.
Next, I want to play a piece by James Conner from Bloor Street Capital in Toronto, and he's interviewing David Hunter. Of course, David Hunter's in the U.S. He's an economist. This is probably going to be the most negative view. Now, let me say this. I have to set the stage for David Hunter if you don't know who he is. He is an economist, and he clearly says that he is a macro contrarian. In other words, he is, whatever the market is doing, he's taking the other side. And so if it's going up, he's trying to look for, okay, what's the negative view of that, and vice versa. So when you listen to this, remember he is a macro contrarian. He predicts a hard landing, and probably next year, probably in 2026. Now, I stay away from predictions. David Hunter does give them, and he gives them from the standpoint of a macro contrarian. Is he right all the time? He's not. He's right quite a bit of the time, but when you start giving predictions and you have to put a time frame on it, it makes it very hard because the economy and the stock market don't go according to precise predictions. But he said, based on what he sees now, probably in 2026. I don't know if he says early 2026, but definitely a hard landing, which means a recession. And he goes on to say, and again, I don't know the time frame on this, that the stock market could have as much as an 80% correction. Well, that's huge. I think Mike Wilson would say 30% or more. I'll play another one. The next guest probably would say 50%-ish. So, but whether it's 30, 50, or 80, those are big numbers. And so, after that, that sets the stage for a rise in the stock market going forward and an improved economy. But anyway, I think he is a thoughtful and well-researched guy. So take a listen to David Hunter.
So I want to start right here. Should we be buying this rally or should we be selling into it?
Yeah, so as a strategist, I don't make recommendations or provide advice, but what I will say is at the bottom of this correction at 4,800, while everybody was lowering estimates and lowering targets, I came in and raised my target from 7,500 on the S&P. I was already a high on the street, I think, and raised it to 8,000, raised my NASDAQ target from 25,000 to 27,000. Sentiment had just gotten so bearish. People were saying the top is in, etc. And I continue to say we're in a final melt up, final leg of a 43-year, soon to be 43-year secular bull market. So I think you've got still a good ways to go before we top. I do think we'll top this year and could top as soon as this summer, but we're not there yet.
I'm sorry, you said your previous target was 7,500 on the S&P?
Yeah, I had a target of 7,500. I think that I put in last September or last summer. I can't remember exactly. I had raised it from 7,000 back at the beginning of 24. So I'm just still saying this thing has plenty of legs ahead.
And to go from, let's just use round numbers, but to go from 6,000 to 7,500 or to 8,000, that's a significant move from here. What's going to be the catalyst? Because when I look at the economy, especially the Q1 GDP numbers that we saw a few weeks ago, it was negative. And then you look at a lot of the earnings that reported Q1 numbers. Some of them were okay. A lot of them were not so good. What's going to be the catalyst to take it higher?
Yeah, and of course you've got plenty of uncertainty out there due to the tariffs and what's going to come of that and what that's the impact we're going to have on the economy as a result of the tariffs or the threatened tariffs. So there's plenty of uncertainty out there, and that's I'm a contrarian, and contrarians are very much driven by behavioral economics or sentiment. And at this point, sentiment is still very negative. It was extremely negative back a month ago, a little over a month ago, and now although we're seeing the retail side getting more bullish, the institutions are still fighting this thing. So there's what I call a big wall of worry to climb. That's very important in my work. At the same time, I think you're going to have, in spite of all the worries right now, I think you're going to have sharply lower interest rates as we go through the balance of this year. I think you're ultimately going to have the Fed come in and ease. I don't worry about consensus view of whether the Fed's going to ease or whether rates are going up or down. My contrarian views are oftentimes at odds with the consensus. So I am actually calling for a recession. I've said many times in recent times we're either in recession now or we're darn close. We're heading for one. So that may sound kind of contradictory to my forecast, but I think weaker economy actually causes sharply lower rates and greater odds that the Fed's going to have to come in here and come in not with one cut or two cuts, but a lot more ease ahead. So that's a big part of it. Again, because institutions are positioned uh, either defensively or bearishly, you're going to have to see them adjust as the tape moves up. And again, with how I approach things, so much of the street and retail investor both reacts to the tape. So when it was going down, they get more bearish. When it's going up, they get more bullish. I tend to reverse that and get more bullish as it's going down and more bearish or cautious as it moves up. I think you're going to see in the next several months an all-in mentality out there. You're going to see a very different viewpoint than we have right now.
So next is Ed Dowd. Ed Dowd is an economist, and he does research. He sells his research. That's his primary job. And the entire interview that he does here is all of it's interesting. I just didn't want to take up a lot of time, so I pulled a piece together that I thought was relevant. He expects a recession in the short run, and he says this year or early next year, maybe first quarter of 2026, not inconsistent with what David Hunter said, and then a recovery thereafter. And he says housing, the stock market will come down, maybe up to 50%. And he says, but that's normal. You've got to have these corrections from time to time. The economy and the housing market will come down. He said he makes the case for the fact that housing prices are incredibly elevated. Very few people can even afford to buy a house, especially first-time buyers. And he said it's so out of whack that it's got to come down. Well, that does make sense to me. He said it'll be painful in the short run, but he said for first-time home buyers, it'll be an opportunity to be able to buy a home that they have up to this point been able to afford. So again, thoughtful presentation done by Ed Dowd.
Would you say that Trump's new policies, potentially this Mar-a-Lago Accord, restructuring the global monetary system, making America investable again, could potentially stave that off, or does that only exaggerate things?
No, look, his plan is this, right? He wants to deregulate, reinstitute the tax cuts. He wants to bring investment to the U.S. The bringing investments to the U.S. is going to take time. You know as well as I do, breaking ground, getting things going doesn't happen overnight. So that is out in the future. It's much like what happened to Ronald Reagan. Ronald Reagan had a recession in 80 and 81. He had a double dip recession. Trump is facing the same problem. His policies are going to take time to enact. The Fed is too tight at the moment, and his policies are actually reversing out the juice to the economy the last 2 years, which was unprecedented deficit spending, illegal immigration, and government job hiring. So just the second derivative change on that is going to create a dip, because the real economy, the middle class economy, you could argue, was in a recession in 23 and 24.
So we have $8 trillion of commitments to be invested in the United States, but to your point, that's going to take a while to see that come to fruition.
Yeah, commitments don't translate into money changing hands yet.
It does, yeah. Now, he has done quite a few executive orders laying the groundwork for like fast tracking these two things, coordinating through all the states to get these things through. I think it was any investments over $1 billion get sort of rubber stamped through. But even then, you're still talking years probably before that stuff happens.
At least 12 to 24 months, and so that's why we wrote the report. His reversal of his policies actually will cause a temporary recession, and then his other policies will bring us out of it. But again, there's a timing issue. So there's a valley before the glory, right? Now,
right.
It all depends on the execution, the timing. If the economy isn't turning around by 2026 midterms, we got a problem. So the idea here is you have a recession that we think manifests itself pretty soon, and the stock market's bottom sometime in the first quarter of 2026, and then you have a recovery. That's the ideal situation, and that's why in our report we're not claiming anything. It's going to go systemic. We're not doom and gloom. It's just we think it's an old-fashioned deep recession, and hopefully it's quick. And typically speaking, in recessions, like in the dot-com recession and the great financial crisis, stocks went down 50% before they recovered. So we're nowhere near down 50% yet, and we think that's coming. And look, it's not the end of the world, right? I mean, home prices going down are while not good for over-levered rich people that are over their skis, it's great for like someone who had a first-time home buyer. So it's just not. People just don't like recessions, and they think it's the end of the world. But it's healthy and it resets things. The problem is, the bankers don't like it, and they keep reinflating and creating malinvestments. So we're going to see what happens in the teeth of this one. The Fed is behind the 8 ball. They didn't lower the. I predicted they weren't going to lower this Wednesday. They didn't, and we might even get some headline inflation reports that look like inflation's accelerating. But you got to remember, in the great financial crisis, inflation was accelerating June, July, and August before everything imploded.
Okay, thank you for listening. If you have questions or comments, leave them in the comment section below. Thanks.